been so much going on the last couple of years that I think is signaling we're about to go through great change. And it's both positive and negative. It's negative because we're about to go through a period of pain, economic pain, but it's positive because there's going to be a rebirth. And the rebirths always have a positive connotations because it means that we can change things.
Welcome, everyone, to another episode of Inside the Markets presented by StockPulse.com. We are more than honored today to be speaking with Robert Kientz of Gold Silver Pros. Thank you so much, Robert, for joining us today.
Hey, thank you for having me on.
So you were mentioning before we started recording the economic data that was released this week. Can you speak to that?
Yeah, we had very impactful economic data come out. The headline that came out on Wednesday had to do with Tuesday, the producer price index, or the PPI, and that's the price that producers are raising, or the percentage that producers are raising their prices that eventually get passed on to the retailers. And what it's a sign of is that we're eventually going to have higher inflation, because that print came out at a 39-year high dating back to 1982 of 9.6% year over year in November. And so we can expect that the CPI number, what everybody quotes as the real inflation number, is going to go up probably for December and early into next year. So it looks as though inflation is definitely not contained. It's getting worse. And I expect for 2022 to really see inflation kick up. Would not surprise me within the first quarter or so to see us hit double-digit official inflation from the US government. And it's already changing the way in which the central bank or Federal Reserve here in the US is reacting. Yesterday, Jerome Powell had a conference in which they announced that they were going to reduce or taper their bond purchases by $30 billion a month until it ends in March, which is a big move by the Fed. And they're also going to raise interest rates up to, by the end of 2022, up to just under 1%. So this inflation that has been persistent and has not been transitory, has stuck with us, is getting worse. The Fed sees all this information, and they did a 180 on their approach to managing the money supply.
Where do you see things headed in 22? So you mentioned double-digit inflation. How bad do you think it'll get for the average family in 2022?
Well, it's going to be difficult. You know, when I grew up, I was born in 74. So I remember growing up being very, very young and dealing with high inflation. Was part of had a single parent family. My mother struggled. I remember us going grocery shopping and things were always rising in price. And the only thing that really saved us back then is we had a fixed rate mortgage. So we could pay our house bill. It was the same every month, no matter what happened, but everything was going up around us. And it really caused us to struggle. I mean, we weren't, a rich family, and we didn't have a lot of discretionary funds. It's very difficult to be able to afford things when prices were always rising with food and clothing and stuff like that. And, you just have to learn to deal with it. I think for the average family, we saw that study come out about a year ago where the average family didn't have $400 extra in their savings account to deal with an unexpected expense. And what's going to happen when prices of things that they pay for every day are rising faster than their wages? I think it's really going to cause a lot of American families to struggle. And really, the best thing you can do is try to get out of debt and try to position yourself in assets that will do well. Gold and silver, of course, or some. We talk about that on the show all the time. But I'm just worried about people who didn't know and didn't prepare ahead of time. I think next year is going to be very stagflationary. We're going to have a lot of inflation, not a lot of job growth and wage growth. And it's going to be difficult for the average family.
What can people do to prepare now?
Well, what you can do now, this is the perfect time to look at your financial situation, examine your portfolio if you have one, look at your expenses, to tighten the belt, cut discretionary expenditures where you don't need them. If you have the money, buy low gold and silver, because over time, gold and silver do very well in inflationary environments. They do well when the economy is not doing well. They'll tend to hold their value. I wouldn't worry about temporary price fluctuations. And I would say just look at, for your portfolio, rebalancing your portfolio. If you're a credit investor or have a large retirement portfolio through your workplace, look at that portfolio and see what your options are. As prices rise and as the Fed raises interest rates, you can expect to see rates rise on things like bonds. So if you're in bonds at a lower rate, it's going to hurt you because the value of the bonds are going to go down. So you may want to think about cycling out of bonds and into other assets. Also be wary of the stock market. It's trading at near all-time highs from a price to earnings ratio perspective, second only to the tech crash, more than before the Great Depression. So be careful of potential stock pullbacks here in the next year to 2 years.
What do you think some of the biggest stories of 2021 were, either on the gold and silver front or in the economic and finance front?
I think from a gold and silver front, definitely was, from a retail perspective, silver squeeze. At the end of January, beginning of February, there was a run caused by an online group into silver, specifically into SLV, the ETF, and drained 110 million ounces out of London stocks of silver through that. And I think we've continued to have very strong retail demand in silver at the same time that the Silver Institute for 2 years in a row has said that we're going to have record-breaking amounts of industrial demand for silver. It was 1 billion ounces this year. It's going to be up another 100 million ounces for next year is their prediction. So we don't have a lot of silver to go around for industrial use. And we're having issues right now with supply deficits. So that was a really big story on the gold silver front. Gold, of course, has sort of drifted sideways most of the year, but it's in a consolidation pattern. This is a normal pattern. So I expect gold to break out probably next year sometime as the inflation data and economic data continues to worsen. In terms of financially, it was restarting the economy and all the inflation that's come through the system. It's been the lack of recovery of jobs. If you look at the labor force participation rate, we're 3 points lower than we were prior to the Great Recession. So we've never recovered in total job availability dating back 12 years, and that's a big thing. While there is a shortage in certain talent in the economy, especially educated talent, there are a lack of people able to find jobs, and that structurally affects our ability to grow. I don't think GDP is going to be strong going forward. I think it's quite possible we'll see some deflationary pressures in the economy. And I think companies are going to move to things like automation and other efficiency improvements that are going to put downward pressure on a lot of jobs. So the way that you position yourself, to find work is going to be very important going forward. And then, of course, at the end of the year, central bank policy shift that I mentioned earlier in the interview, as a result of all of these factors, the economic factors and the inflation factors. I kind of think that the central bank right now is just sort of managing the sinking of the Titanic. They're trying to keep it from going down all at once and manage this, the end of this fiat central bank system that we have. And I think they're going to try to manage it over the next several years. And but I think that's where we're headed in the medium term.
For those who don't know, can you explain the silver squeeze and how that happened, what it was, and if we'll see something like that again crop up?
So silver squeeze was there was Wall Street bets, and they were on Reddit. So Reddit's one of these social media outlets, and they were basically getting people together to buy things like AMC and other companies, thinly traded companies, to drive the price up, to make money. And then somebody mentioned silver, and silver went nuts, and then Wall Street Silver started on Reddit. And there's been that whole movement of about 150,000 people following that this year, which is phenomenal. We've had so much interest, especially in the younger generations, in the precious metals that we haven't had in years past. But, it shows that silver is such a thinly traded market. It doesn't take much for there to be a run on silver. There was a run on silver in 3 days, 110 million ounces off London, that the LBMA came out a couple of months later and said if we'd had 3 more days of that, we would have been out of silver in the London market, like completely out. That's how close we were to having a worldwide run on above ground silver stocks. So silver is so thinly traded, and there's so little available, and we're running deficits every year. The miners can't keep up. We're not finding the big mines anymore. And so now we're relying on less proven and probable reserves of silver, increased demand, industrial demand, people getting interested, especially in the younger generation, from an investment perspective. And I think that's going to cause incredible upward price pressure on silver in the next few years.
You mentioned inflation, and I know we discussed that a little bit, but I want to dig a little deeper. You mentioned the 70s. So from, I think, about 76 to 81, there was a economic crisis that cropped up in numerous sectors in the American economy. How does today parallel to what we saw in the late 70s?
Well, I think you are going to see similar high inflation. I think the difference in the 70s was we didn't have such an issue with debt. We had debt issues. We've been taken off the gold standard by Nixon in 71. That caused gold price to accelerate to really probably more of its true market price. And you saw problems in the 70s. You saw, oil issues, energy issues. We're seeing again. So that's a parallel. We're seeing very high energy prices. We're seeing energy crisis simultaneously in China and in Europe. That's going to cause geopolitical tensions because certain countries are rich in certain energy commodities and certain countries aren't. And that tends to cause, a geopolitical realignment, which I think is probably the long-term consequence of all of this realigning of, who's with who from an economic and military perspective. But yeah, we do have energy crisis. We do have high inflation. We have weak job growth. Those are similarities. What we haven't seen yet is the breakout in the gold price. I think that's coming. And I think this is a precursor to it. And I think we'll see that. But the main difference is we're so over levered at this time. And we're running such huge deficits from a sovereign level. And also, if you look at consumers, one thing that Powell said in his press conference yesterday is consumers are very strong. And I beg to differ. We're at the highest debt levels for consumers ever in history. We're at the highest debt levels for the corporates ever in history. We're at the highest debt level for the sovereigns ever in history. The system is awash in debt. So where you could have somebody like a Volcker come in and raise interest rates very high and tamp down that inflation and get control back of the economy back then, you can't do that today. It would completely crash the system. We're too dependent upon cheap credit and free flow of money printing. And that's the major difference. So we're not going to have a Volcker moment. Powell can't pull a Volcker this time around. He's got to be very careful in managing what's happening with central bank policy in regards to the economy. He's got a much tougher job. And so I think you're going to see policy reaction very different from the Fed this time.
You mentioned if we raise interest rates like Volcker did, the system would crash. What would that look like?
So everybody's dependent upon the dollar, right? The entire world is dependent upon the dollar, the petrodollar. Now people are getting out of it. There was news in RT the last few days that Russia and China are, getting out of the dollar and doing. We've known that they're putting in alternatives to the international wire system called SWIFT, which is how big entities transfer money across the world. We know the de-dollarization is occurring. But if last time we tried to raise interest rates up to like 2.5%, 2.75%, I forgot what it was a couple of years ago, we had a 20% stock market correction. Now we're at much lower interest rates. We're at 0.08 officially. It's basically negligible. It's basically free money. If you start to raise those interest rates, what happens when you try to refinance all that corporate debt? What happens when the interest rates on loans go up and consumers can't afford them, on credit cards, on auto loans? The economy deflates. Because with higher interest rates, you can buy less stuff. The prices have to fall or people demand less of something. Homes, cars, can buy less food, less discretionary, less vacations, stuff like that. So the economy begins to deflate at the same time that you're doing this. And this is what scares the Fed. They don't want a deflating economy. Their entire model is built upon forever growth. It never stops ever. And as soon as you have any deflationary impact, it really screws the system. So there's a big danger of that causing a crash. Now, if that happens, if we have a big deflation in economic output, while we're also running persistent inflation in the monetary system, the Fed will have no choice but just sit there and print money. And that's where you have your crack up boom moment, like the Austrian economists always talk about. That's sort of the end stages of any, fiat system that we've seen throughout history.
You mentioned that the Federal Reserve and the central bank is essentially at this point just trying to manage the slow, death, we'll call it, of the fiat system. Mm-hmm. Could you explain why that's happening now and then what replaces it?
So it's happening now because we're at the end of the dollar system. It's the end of the Bretton Woods, really, because we had Bretton Woods and then we had, a gold-backed dollar, petrodollar. Everybody used it. Everybody traded in dollars internationally. Then in 1971, because people were not stealing, but taking all of our gold, especially Europe, because they realized we were overprinting dollars. So we'll give you back your dollars and give us the gold. 71 Nixon took us off the gold standard, and it's been pure fiat. Every pure fiat currency in history has failed. We've had several in the United States that have failed. One that failed during the Civil War. They just don't. Because what happens is government prints so much that there's a confidence event and people stop using it. They know it's going to happen. They're not dumb. And they planned for it. So the IMF, the International Monetary Fund, put out a position paper in 2015 that outlined central bank digital currencies. Since then, the Bank for International Settlements and 50 central banks have announced that they want to follow this plan into central bank digital currencies. These are not like Bitcoin and Litecoin and Ethereum and Monero. These are centralized. Okay, they are using blockchain type ledger systems, but they're controlled by the government. And what they also wanted to do in that paper, the IMF wrote, is they would use negative interest rates in the banking system, not just in the debt system, but in the banking system, so that your electronic money could be reduced in value over time. And that would allow them to control aggregate monetary flows more directly. In other words, what it allows the central bankers do is to directly control everything without having to go through the debt-based system and without having to control actual physical money. It could be incredibly scary if you're worried about centralized control of the monetary supply. But what it does is really completely give them control over the economy. It reduces economic freedom, really, more than anything. That's a system they've written about. It's out there. You can go read it on the IMF, the position paper, and the follow-up blogs. They've said they want to get rid of cash currency. They want to get rid of the debt system. So there would have to be some sort of financial reset along the way. The financial reset would be revaluing real assets like gold, silver, land, things like that. And then devaluing paper assets like bonds and even potentially stocks. And that's, when they talk about the financial reset at the World Economic Forum and in Davos and all of these supranational agencies that have been talking about the reset, that's what they're talking about. They know it's the end of this monetary system. They think they have the next system in place, and they're trying to get people to adopt it and to agree to it. Where they're going to run in trouble is popular sentiment. I think a lot of the banking system is on board with it. A lot of the governments are on board with it, certainly. But I don't know that the people are on board with it. Experiments in central bank digital currencies, like in China, have met with a lot of resistance. And they're not quite ready yet anyway. The UK and the US are probably so far behind China and Europe in this. Not everybody's ready for this system, right? It can't happen tomorrow because it's just not ready. But they've got to somehow get people on board with this. And I think what's going to happen is when the crisis comes, people are going to be so afraid that they may gravitate towards what is next from the central bank. And so what we try to do is just educate on what the system is, just so you know what it is and you can prepare yourself financially for that when it comes about.
The Great Reset. Can you explain for people who don't know what that is? You've touched on it a little bit.
Mm-hmm. The Great Reset is defined by these financial elites, central bank heads, government types. They've been talking about it. So it's not a term coined by the blogosphere or anything like that. It's their term. And what it means is the old system dating back, essentially the 1800s when central banks started popping up, but really 1913 when you had the Fed in the US. That system of creating money through debt has run its course. Basically, it was a giant Ponzi system. It served whatever need that they thought that the world needed at the time. Prior to that, we used gold competing with currencies, and we had much better price stability, less frequent recessions. People were rewarded for saving. In this new system, the last 108, 110 years has not rewarded that. It's encouraged speculation, overspending, misallocation of capital, excessive debt to a level that nobody on planet Earth has ever seen in any economy ever. And that system has to blow up. I mean, there's only so much production from the future that you can pull forward, which is essentially what you do when you offer money for free and you issue all this debt. There's so many resources we pulled out of the ground because they were so cheap, things like that. Well, now we're seeing resource constraints, we're seeing financial constraints. So the system cannot support itself anymore. We're overheated. Just think of an engine that's about to blow its cylinders, right? It's overheated, it's got to blow. So the Great Reset is the reimagining of that system. And it's happening on a bunch of fronts. Gold is now becoming center stage in terms of central banks because of Basel III and how it's going to be recapitalized in the banking system and support the central banks and the commercial banks. They don't want gold and silver as money, but they do want it as a reserve asset. And that's a way for them to compare, which central banks are doing better. Their assets of other bank stocks, their gold, and their digital cash, I think is what they're going to use. So they have to reset the monetary system. They have to reset the financial system. What's going to happen with interest rates is instead of these committees determining things like the LIBOR, the London Interbank Offering Rate, of which so many things are determined, like mortgage rates and things, They're going to do derivative-based interest rates now. They're going to let the market go out and decide, right? And the regulators are going to regulate all that. So the entire system is changing. It's becoming more derivative-based. It's becoming more centralized. The policymakers want control. They think they can do it better. They don't believe in free market. These people are not free market. They don't believe that the market can make their own decisions. They believe that they need to make them for people. And that's essentially what it is. Of course, there's going to be a lot of regulation changes, a lot of law changes. And I'm not sure that the people really understand what's coming and how that's going to affect them. I think there are going to be a lot of surprises over the next few years as they figure out, what the planners have decided. And at the end of the day, whether that system is successful or not is if people decide to accept it. I guess if the crisis gets bad enough, they will. Right now, if they said, we're just switching over to digital currencies, we don't want you to own gold and silver. We're going to change the entire financial system. We're going to crash everything. So everything that you own basically is pennies on the dollar, but we have to do it to reset it. If they came out now and said that, it wouldn't happen. People don't want that, obviously, to happen. They're going to have the crisis where the system implodes on its own, and eventually it will. I mean, it was basically designed not to be a forever system. It was designed just to deal with the problems we had back in the early 1900s. But that system was never going to stay in place forever. And I think that's the thing that people have the hardest time accepting. People have the hardest time accepting that we're not going to be in a dollar-based worldwide economy anymore. But if you look at history, I mean, we never should have expected that in the first place.
How does Basel III fit into all this and gold?
So Basel III is a set of banking regulations that came about as a result of the Great Recession, 2008, 2009. I think it was first proposed in 2012, and I think the first working model came out somewhere around 2014. And they're trying to comply with it ever since. And it's not just gold. I talk about it as in relation to gold on our show, but it's not just in relation to gold. It's in relation to the entire banking system. And there's tons of regulations in there. It's a very thick system because banking is very complicated. But essentially, they're trying to improve the liquidity of banks. They're trying to regulate how the banks manage themselves from a financial perspective so that they can deal with supply shocks. And there are a lot of good things in there, actually. It requires better and more capital reserves of higher quality. Now, I could look at some of those capital reserve requirements and criticize them and say they're not real high quality because they're paper derivatives, but at least they're trying to do something to stabilize the banking system. But Basel III is just a set of regulations designed to better increase the stability of the banking system. They've largely failed. There's sections of it they're still not in compliance with all these years later because they can't, because you're sitting at the end of this system, that's going to crash. And so in other words, there aren't enough great assets out there to really protect the banking system when it crashes. And I think what's going to happen is you're going to have severe banking panic during the crash, despite the Basel III. And some will come out ahead of others, obviously. Some central banks will come out ahead of others. China and Russia are very well positioned with high quality assets like gold. Germany's trying to get their gold back. I mean, that's why there was a rush to everybody to repatriate their gold out of the Bank of England vaults and the vaults in New York, is because they're like, we need high quality assets, for when this reset comes. But I think there is going to be a banking panic despite Basel III efforts. And, I think that's going to lead us into the new system, essentially.
Gold and silver miners, what have been the stories in that sector in 2021 as you see it?
So we've had a little bit of merger and acquisition going on, some really smaller miners wanting to become multiple project companies to get noticed and to get leverage and to get coverage and to get investment have started to merge. We've seen companies, I think Ken Ross came in and took out Great Bear. So we've seen some of the mid to majors in the precious metal space start to accumulate assets. It's all about ounces in the ground. And the thing about gold and silver miners is as soon as you pull up an ounce, you have less inventory. And you can't just make a new one. It's not like making iPhones, right? We don't have an unlimited supply of it. It's very limited assets, natural resource. So they've got to go acquire more. So what you're seeing is some of the majors saying, oh, we need to get ounces. How do we do that? The easiest way for them is to go acquire somebody else who's already found something, because exploring is not yielding these really big, high-grade gold and silver deposits anymore. Well, there is some being found in silver in Mexico and Peru, but relative to where we were 50 years ago, none of the deposits are the same quality or the same size. So you're seeing some of this M&A activity. The miners themselves are trading below not only the general stock market, way below. They're way undervalued to assets in the ground, or what we call net asset value of those reserves and resources. They didn't recover to where gold and silver did. Gold and silver have been, well, gold especially, it's been on a nice run since 2016, especially the last couple of years. Formed a nice little cup and handle pattern, which is why gold investors are so positive. And we had all-time highs last year, over 2000. So silver's done pretty well too. It's recovered into the 20 to 30 range when it was down, trading about 10, $11 there for a while. But the miners have not recovered, even though they're making money. Most of them are making money, the ones that are producing. The ones that are finding stuff in the ground, they're feeling positive because they know that they would make money based upon all their economic assessments. But yet the sector hasn't recovered. It's unloved. It's just not the bell of the ball. Or the bell of the ball right now is the momentum chasing. And that has a large part to do because of passive investing into the general stock indices where people put their 401ks. The bulk of the money goes in passive investing. It's all driven by computers, and the computers aren't recognizing, these value investments. It's not value investment right now. It's momentum chasing and growth investing. That will change. It always changes over time. The money will flow back down through the miners, especially when we have the crisis. When we have the crisis, gold and silver go up. People will turn attention to the miners. The generalists will come back into the mining space. The big institutions will put a lot of money into it. And that will change, and the gold and silver miners will do very well. For those of you investing right now, just know that we're in a big cycle change. So this can go on for a while. They're not going to, until the economy really hits the skids, you're not going to see a huge, overwhelming bid in the gold and silver miners. You may see some guys pop out of there that do pretty well. And the index may trend up, but it's not going to hit a big, a big bull market until gold and silver move up. And that's going to come during the next crisis. So if you're investing now in the miners, I just say be patient. Pick the best companies you can. Pick ones that have great management teams, great jurisdictions, good resources that have done it before, and just invest in them and hold if you want to get in there. And certainly you have time to research.
I wanted to make sure we had time to get in the miners, but I did also want to ask you, how does it feel watching real, tangible world history unfold over the last 18 months?
It's been incredible. There have been so many changes in the world. When I grew up as a fairly stable time, I grew up during the 80s. The Berlin Wall fell. I think it was one of the best decades for music, and just people felt free. I think the feeling I got growing up, we were very free. You could go outside and play late at night and not worry, and you didn't worry about what was going on around you. Now it just seems like everybody's worried all the time. We're worried about world events. We're worried about the economy. I saw a study that people are, this new generation, there are less marriages and things like that. So people don't feel as comfortable building families, and it's just a different era. And there's been so much going on the last couple of years that I think is signaling we're about to go through great change. And it's both positive and negative. It's negative because we're about to go through a period of pain, economic pain, but it's positive because there's going to be a rebirth. And the rebirths always have positive connotations because it means that we can change things. So I would say history is being made, but don't stay on the sidelines of history. Get your voice out there, make it heard, because the world that we're about to come into is going to be our world if we want it to be. If we want, we can remake this world how we want. We can go back to democracy and freedom and, less centralized control and, more power to the people sort of thing if we want. I mean, it definitely is within the realm of possibility.
We've had the honor of sitting down today with Robert Kientz of Gold Silver Pros. You can find his work at goldsilverpros.com as well as on YouTube. Thank you so much, Robert, for joining us today.
It was an absolute pleasure being on the program. Thank you.
And thank you, everyone, for listening to StockPulse.com's Inside the Markets.